BEML's historical reputation is built on heavy industrial machinery. Today, the company commands a market capitalization of nearly 15,000 crore rupees. But this financial dashboard reveals a pricing anomaly. BEML trades at a price-to-earnings ratio over 100, while top-line sales growth sits at negative 0.79. The core difference is time horizon. One model relies strictly on current, lagging cash realities, while the other predicts future operational scaling. To justify this 15,000 crore valuation, the market is entirely ignoring current earnings and pricing in a fundamental strategic pivot. A 100 PE ratio becomes rational only if BEML has the balance sheet and institutional backing required to execute its $3.3 billion order pipeline. A strategic pivot in heavy engineering requires vast amounts of capital. To scale at this size, a company needs a stable financial foundation. This capital structure gauge shows their reliance on debt is remarkably low. The debt-to-equity ratio sits at a negligible 0.07. Looking at short-term liquidity, they maintain a current ratio of 2.65, meaning short-term assets easily cover liabilities, alongside a stable operating margin of 12.79%. While their net debt has ticked up slightly to 270 crore rupees, it remains highly manageable against their overall liquidity profile. BEML possesses the solvent, de-risked balance sheet required to fund this scale of aggressive expansion. With the balance sheet secure, we have to look at the cap table to understand exactly who is holding the stock at these elevated valuations. The primary ownership block reveals that the promoter group holds an absolute majority, controlling over 54% of all shares. Identifying this promoter establishes the sovereign safety net underneath the company. The majority shareholder is the President of India. The security of the sovereign holding is absolute. Rows 7, 8, and 9 of this declaration confirm none of these shares are leveraged or pledged. This uniform column of no answers guarantees the government's equity is fully locked in and insulated from margin calls. The secondary layer of this institutional moat is formed by domestic institutional investors, specifically mutual funds. They hold a 17.5% block, indicating significant institutional trust in management's future guidance. We also see clear foreign institutional participation, proving international funds are buying into the pivot thesis as well. Combined, these foreign portfolio investors account for over 5.5% of the shares. This impenetrable cap table, anchored by sovereign backing and layered with heavy institutional accumulation, acts as a rigid price floor. It gives the market the structural confidence to assign a 100 PE premium. But a financial safety net doesn't generate revenue. To justify the price, we have to examine the actual operational catalysts driving the stock. BEML has structurally reorganized into 12 distinct business units to facilitate a revenue shift away from its legacy operations. Traditionally, their core business relied on heavy earth-moving and mining equipment. Today, that legacy mining and construction segment has decreased, now making up 41% of total operations. Taking its place is their defense manufacturing unit, producing specialized military mobility platforms. Defense systems revenue has climbed to 35% of the total mix, as BEML capitalizes on India's defense indigenization push. The second major catalyst driving this high-tech pivot is rail infrastructure. By expanding into high-speed sleeper trains and metro rail systems, they have positioned themselves squarely inside a high-growth sector. Looking at this pipeline chart, we see their current execution baseline. BEML's verified order book sits at just over 15,800 crore rupees. But the market is pricing in their target for the current fiscal year, a $3.3 billion order pipeline, representing roughly 27,500 crore rupees. Investors are pricing BEML as a specialized technology integrator, valuing the company's future potential at nearly twice its historical execution scale. However, a pipeline target is not actual revenue until the contracts are signed, the technology is built, and the products are delivered. This risk assessment dashboard highlights the lingering drag of their legacy metrics, a return on assets of 5.32% and a dividend payout near 30%. That low return on assets proves the company historically struggles to efficiently convert its investments into actual net income. To maintain that 100 PE premium, BEML must improve this efficiency while converting its $3.3 billion pipeline into high-margin revenue. BEML's valuation depends on its ability to convert these targets into realized high-margin contracts. If they face delays in order execution or stumble in scaling production, their multiple is entirely unsupported by current cash flows and will face severe contraction. BEML is a high-stakes execution play. Investors at these levels aren't buying the company's past. They are paying a premium for a debt-free, sovereign-backed monopoly to execute the pivot in its history over the next 12 months.